What if I told you the two largest rivals in global trade just swapped jet engines for rare earth minerals in a London back room, and almost nobody's asking what the fine print means? Before we dive in, pour that coffee. Today's story isn't about tariffs on toys. It's about leverage. How Washington and Beijing rewired supply chain power, one export license at a time, and what this fragile ceasefire means for your phone, your EV, and your portfolio. Let's begin. From 2018 through early 2025, tit-for-tat sanctions shoved some tariff lines above 100%, freezing $500 billion in goods. Firms paid the bill. Consumers felt the pinch. Last month, negotiators met quietly in London and drafted a framework. The U.S. lifts curbs on aircraft engines, chip design software, and ethane. China relaxes its rare earth chokehold. If that playbook sounds familiar, it should. Empires under stress pawn strategic assets, Britain's Suez shares, Russia's oil IPOs. Now, America and China are bartering tech secrets for mineral access. This isn't friendship. It's raw pragmatism. Boeing and GE can ship engines again. Synopsys and Cadence reclaimed China revenue, and Wall Street cheered. EDA stocks popped 6% on licensed news. So why now? A 90-day tariff pause. Trump's Liberation Day reprieve expires July 9th. Reimposing 55% blanket duties would slam mid-sized U.S. firms with $82 billion in extra costs. A narrow truce buys breathing room and political optics. Here's the twist most analysts miss. The deal moves risk premiums. Beijing's pledge to review eligible controlled item exports, code for neodymium, dysprosium, terbium, pulled futures prices down 9% in a day, yanked the license, and missile guidance factories stall within weeks. Winners? Jet engine makers, chip software vendors, ethane exporters. Losers? U.S. rare earth startups hoping Washington would onshore the whole magnet supply chain. IPO bankers aren't left out. J.P. Morgan says Chinese magnet firms could tap U.S. markets for $8 billion if the thaw sticks. Fees nobody forecast a month ago. Private equity funds are circling logistics outfits that specialize in priority licensing for dual-use goods. A back-office niche suddenly worth gold. Watch the ripple. The rare earth ETF Remix spiked 9% on the announcement, then surrendered half as traders priced in fresh supply. EDA names rallied. Copper miners yawned. Markets see a tech mineral swap, not broad peace. Regional banks holding loans to small U.S. magnet factories feel the heat. If Beijing flips the export switch off, cash flows collapse, and those lenders, already shaky after last year's rate shock, take the hit. Here's the angle CNBC won't spell out. Rare earth access is America's stealth form of sovereign borrowing. Instead of issuing bonds, Washington leaned on China's mineral monopoly to keep defense supply chains humming. Cut that cord, and the Pentagon pays scarcity premiums that dwarf tariff revenue. Global funds noticed. The dollar index slid to a 3-month low while money rotated into euro bonds and, ironically, Chinese industrial debt. Betting Beijing now holds the stronger hand. So the question, does this micro-truce give U.S. planners leeway, or does it cement China's leverage? Every time a rare earth shipment clears Shenzhen, Washington owes Beijing a favor, and favors accrue interest. Hard truth, no magnet factory opens in Texas tomorrow. No cobalt mine in Nevada hits scale before 2028. Supply chain independence is years away, and both capitals know it. Consumers may see a few dollars shaved off smartphones and EVs, but tariffs still sit at 55% on U.S. lists and 10% on China's. Manufacturers pocket most of the relief. Retail prices lag the headlines. History rhymes. The 1980 U.S. grain embargo détente, with the USSR collapsed within 2 years when tech sanctions returned. Expect similar whiplash, Taiwan patrols, cyber hacks, or a campaign trail tweet could shove us back to escalation overnight. So what happens if trust breaks again? Scenario A, Taiwan flashpoint. A PLA jet crosses the median line. Washington freezes engine licenses within 48 hours. GE stock tumbles, gold spikes. Scenario B, cyber breach. A hacked U.S. port scanner traces to Shenzhen. Commerce yanks EDA access. China counters with an overnight halt on heavy rare earth oxides. Dysprosium prices triple. Scenario C, election rhetoric. Tariff threats ramp to 70%. Dollar rallies briefly, then slides as foreign buyers dump treasury debt tied to mineral dependence. What should one watch? 1. Watch the minerals cycle. Follow production shifts across diversified mining firms and monitor dependency risks in single-source magnet supply chains. 2. Ride aero engine cash flow until the next license scare. 3. Watch tick data. A sudden drop in foreign demand for agency bonds is your early alarm that minerals leverage is biting. And let's be clear, neither side fixed the math. America still imports 74% of its rare earth magnets from China. China still buys U.S. chip IP it can't replicate. This truce is a handshake over a fault line. Washington could subsidize refining in Texas, but officials admit first commercial output is at least 3 years away. Beijing, meanwhile, stockpiles jet engines and EDA tools as insurance. The leverage gap widens. So pay attention to July 9th, tariff pause deadline, weekly commerce license bulletins. One revoked permit can move markets. China's customs data on dysprosium, the first sign of a squeeze. If this breakdown helped, share it with someone who thinks trade war is just a headline. Drop your take. Is this détente a turning point or a timeout? And hit subscribe for more macro dives. History rhymes, power rebrands, stay inquisitive.